Hey folks, this is Colby Valenta with Valenta Capital Management. Hope you're all having a great day so far. Wanted to touch base with everybody now that October 2018 is done. It was certainly a volatile month, so we really wanted to chat about that, put it into perspective, and kind of give you our thoughts. So obviously, it's no surprise that anytime we see market fluctuations like we saw in October, investors, typically speaking, will get a little bit nervous. So we're here to help you better understand what happened in the market and really, historically, how to put it in perspective and kind of see how we bounce back from some of these corrections that we've seen in the past. So let's take a few steps back so we can gain a wider perspective of what's actually happened. Naturally, when investors watch markets fall or rise, they really begin to wonder what's going on, what's really driving the movement up or the movement down. So we see things like worries about inflation or interest rate increases, but that's only part of the picture. The bigger picture and the bigger thing that we need to look at here is volatility. And volatility, historically speaking, is normal. So let's consider a few facts. The S&P 500 has undergone an average annual correction of about 14% per year dating back to 1980. 2017, though, was very different than what we've seen historically for the index. Markets were pretty calm, unusually calm, actually. They only fluctuated about 3%. So prior to the drop-off that we saw in February of this year, the S&P went more than 400 days without losing 5%. That's the longest time we've seen since the 1950s. So let's remember this as well. Yes, the S&P fell 4.1% on February 5th, but the next day it gained back 1.7%. So if you look at the S&P 500's 15 worst days when it lost an average of 8.16%, stocks were still down a day later. But looking at the longer view, in 13 of those cases, stocks were back up 12 months later, on average 21%. So here's what we need to keep in mind. When stocks drop, they'll eventually turn around and start to post positive gain. So let's go back to the last market correction that we saw. In August 2011, the S&P lost 6.66% in one single day. Europe was facing a debt crisis, the AAA credit rating of USA was downgraded, and financial markets were shaky, and investors were understandably nervous about what was going to happen. So the temptation back then, just as it might have been in October, was to pull your money out of the market, sit on the sidelines, and wait around. However, staying invested really did pay off because a year later, the S&P had gained 25% or more. So what can we learn about what we saw in October? Over the short term, markets trade on fear, anxiety, greed, and emotion. Over the long term, sound economic fundamentals drive the market and drive its growth. So market fluctuations might be a very difficult lesson to stomach and a difficult lesson to learn. And you as investors might still be wondering whether things like inflation rate increases will go up or the Fed's going to continue to raise interest rates or whatever it might be. But the reality is the volatility that we're seeing in the market may very well continue. So last year's uncharacteristically calm market makes it pretty hard to deal with a year that's more normal. We made money, the markets didn't fluctuate all that much, and we're now in a more normal market cycle looking back historically, comparatively speaking, but it's still hard to deal with. So on a positive note, if the degree of volatility that we are experiencing is here to stay, new market opportunities will become apparent. So there's an economist at First Trust who said more economic growth should be a tailwind, not a headwind for us moving forward, and we agree with that. So we really want to encourage you to maintain your focus on your long-term goals. Don't allow emotions to sidetrack you. We want you to be confident in what you're doing here. So if things like your investment objectives or your timeline or your horizon has changed, give Mike or I a call. We'd be more than happy to chat through that with you. That's why we're here. Because if we need to make a craft in your strategy, it can't just be because I saw short-term market fluctuations. We need to know everything about you, right? We need to know why you're going to do what you're going to do and how to craft a good financial plan for you moving forward. So please know we're here to talk. We're here to provide clarity, answer your questions, alleviate any fears as best we can. If you'd like to chat, please reach out, 303-951-5975. Once again, this is Colby Valenta with Valenta Capital. I really appreciate your time. Now, I just need to list a few disclosures to keep our attorneys and regulators happy. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice nor a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing includes and involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested in directly. Past performance does not guarantee a future result. Thanks.